right, welcome everyone to another deep dive. Today we're tackling a real classic, a book that's considered essential reading for anyone who wants to understand how to think about business and investing the Warren Buffett way.
We're talking about the Essays of Warren Buffett, of course, compiled and edited by Lawrence Cunningham.
This book, it basically takes all those brilliant insights from Buffett's famous shareholder letters, his speeches, all those little nuggets of wisdom he's dropped over the years, and it organizes them all nice and neat by topic.
And our goal today, right, is to really pull out those core principles, the big ideas that make up Buffett's investment philosophy, and try to figure out what makes his approach so successful. We want to highlight those aha moments, those insights that really make you think differently about how to approach business and investing.
We're going to walk through some of the most important points in the book, share some of our favorite Buffett quotes that really drive those ideas home.
And we'll definitely talk about Lawrence Cunningham and what he's done to make these ideas so accessible.
Because this book, it really is a must-read. But first, let's dive into those owner-related business principles. One of the first things that jumps out at you is Buffett's preference for owning a whole bunch of different businesses, right? He's all about diversification. But here's the thing. He emphasizes those that earn what he calls consistent average returns. So what's the deal with that? Average doesn't sound super exciting, does it?
Right. You wouldn't think the world's greatest investor would be aiming for average, but, it's not about settling for mediocrity. The real key here is consistency. Buffett understands that steady, reliable returns, even if they're not spectacular in any given year, that's how you build long-term wealth. He's not chasing the latest hot trend or trying to hit home runs every time.
So it's more like slow and steady wins the race kind of thing.
Exactly. He's playing the long game, building a solid foundation of businesses that can generate profits year after year like clockwork. And, he's contrasts this with how Berkshire's insurance subsidiaries operate. They buy pieces of outstanding companies, but through the stock market.
So there's like a strategic flexibility there.
Absolutely. They let the opportunities dictate where the money goes. If there's a great business available for outright purchase, great. But if the market's offering attractive prices for a piece of an exceptional company, that works too.
He even mentions that buying a slice of a company through the stock market is usually easier than going through the whole acquisition process.
Right. Less hassle, less negotiation, you know the drill. But the goal is the same, owning pieces of businesses that can compound value over time. And this leads to an interesting concept that a lot of people might find counterintuitive. Berkshire actually benefits when the stock market goes down.
Wait, seriously, most people would freak out when the market tanks.
Think about it this way. When prices drop, those wonderful companies that Buffett loves to own, they go on sale.
Makes sense.
It's like a dream then true for a value investor. So Buffett's advice is clear. Don't panic when the market dips. For Berkshire, it's an opportunity.
So he's buying more of those great businesses at a discount, and his existing holdings can buy back their own stock cheaply too.
Increasing Berkshire's ownership on the cheap. It's win-win. But here's where things get a little tricky. Because Berkshire owns both entire companies and these significant stakes in others, their published earnings, the one you see in the news, they don't really tell the whole story.
Right, because accounting rules get a little messy when you have such a diverse portfolio.
Exactly. The real key to understanding Berkshire's success is looking beyond those headline earnings numbers and understanding the power of retained earnings. The profits that the companies they own are reinvesting back into their businesses.
Okay, that's interesting. So he's basically saying those retained earnings are just as valuable, if not more so, than dividends that Berkshire would receive.
Absolutely, especially when those earnings are being reinvested by exceptional businesses, companies that can put that money to work and compound it effectively. Think of it like a snowball rolling downhill.
It just keeps getting bigger and bigger.
Exactly. Now, Buffett is very transparent about how they communicate this to their shareholders.
Which makes sense, given Berkshire's reputation for being so open with their investors.
Exactly. So the annual report, that's where you find all the really important valuation-relevant information. And then the quarterly letters, they provide more regular updates, keeping shareholders in the loop.
And of course, there's the legendary Berkshire Hathaway annual meeting where Buffett and Munger spend hours answering shareholder questions.
It's a masterclass in open and honest communication. They talk about their successes, their mistakes, they're not afraid to address the tough stuff. But there is one thing they don't discuss publicly, their specific stock purchases and sales.
Right, they're pretty tight-lipped about their current move. Why is that?
Well, think about it. If everyone knew what Berkshire was buying or selling, it could create a frenzy, driving prices up or down artificially. That wouldn't be good for anyone.
So they stay silent to avoid speculation and prevent rumors from spreading.
Exactly. They let their actions speak for themselves. Now, let's talk about corporate governance. Buffett has some pretty strong opinions about how companies should treat their shareholders.
He's a big advocate for treating shareholders like true owners, not just passive investors.
He's even called it shameful that a lot of recent government's reforms have come from pressure from regulators, not from a genuine belief that shareholders deserve to be treated with respect.
So it's not just about ticking boxes and complying with rules. It's about a fundamental respect for the people who own the company.
Exactly. And this leads into his skepticism about management making all those growth projections that Wall Street is always so eager to hear.
Right, Buffett and Munger, they're not big fans of those pie-in-the-sky forecasts. Why not?
Well, they see it as a recipe for disaster. When CEOs get caught up in making these grand promises about future growth, it creates this pressure to deliver, even if it means sacrificing long-term value to hit those short-term products.
So they're more interested in building sustainable businesses than meeting Wall Street's expectations.
Exactly. Buffett wants managers who are focused on the long game, who are thinking about building enduring businesses, not just pumping up the stock price next quarter. He's also very wary of those CEOs who spend more time courting investors than actually running the company effectively.
It's like they're more focused on the showmanship than the substance.
And Buffett points out how tough it is for investors to tell the difference between a truly visionary CEO and someone who's just full of hot air. Is this person the real deal or just a master salesman?
It's a crucial distinction. Now, on a positive note, he's incredibly grateful for those managers who run Berkshire's permanent holdings.
He really admires the people who are passionate about their businesses, who think and act like owners themselves. He calls them partners, not just managers.
They have integrity, ability, and they truly care about building something lasting. Now, given Buffett's age, there's always been this question of succession. Who's going to lead Berkshire when he's no longer at the helm?
He even jokes about how the question has shifted from what happens when you get hit by a truck to what happens when you don't get hit by a truck, with his incredible longevity and all.
So how does he see the future of Berkshire's leadership?
Well, he outlines 3 different ways that ownership and management can be structured in public companies, right?
Okay, this sounds interesting. Let's break those down.
The first is widely dispersed ownership, where there's no single owner or group calling the shots. This can sometimes lead to situations where boards of directors have trouble holding management accountable. The second is the owner-manager structure, which is how Berkshire currently operates. Buffett and Munger, they own a big chunk of the company and are deeply involved in its management. And the third, well, that's when a company transitions to having professional managers without any significant owner control, which, let's be honest, is the eventual path for Berkshire.
So which structure does he think is the best?
He believes that when you have a passionate owner-manager who's deeply involved in the business and truly aligned with the interests of the shareholders, that's when you get the best results.
It just makes sense. You have someone who's both capable and incentivized to make the best decisions for the company over the long term.
Right, and they can course correct quickly when mistakes happen, and that's exactly what Buffett and Munger have been doing at Berkshire all these years. They are those owner-managers.
And no plans to change that anytime soon, right?
Not as long as Buffett's health holds up, which, knock on wood.
I love the analogy he uses for managing Berkshire's subsidiaries. It's like managing a golf team with superstars like Jack Nicklaus and Arnold Palmer on it.
You give them the freedom to do what they do best. No need to micromanage brilliance.
Exactly. Trust and delegation are key. He points out that a lot of Berkshire's managers, they're already independently wealthy. They don't need the paycheck, but they're driven by that passion for their work, that desire to excel.
And the fact that they think like owners, that's the highest praise Buffett and Munger can give.
Right. It shows they're in it for the long haul. They care about the business as if it were their own. And Buffett also stresses that they don't let accounting considerations override economic reality when making decisions.
Their long-term focus and their shareholder base gives their managers the freedom to focus on building those durable competitive advantages. Short-term earnings targets, those take a backseat to long-term value creation.
Now let's shift gears a bit and talk about disclosure. Buffett highlights this unique program they have at Berkshire, the Shareholder Designated Charitable Contributions Program.
Yeah, it's pretty amazing. Over 95% of Berkshire's shareholders participate in this program.
That's incredible.
And you know who came up with this brilliant idea?
I'm guessing Charlie Munger.
You got it. And Buffett gives him credit for a lot of other great ideas at Berkshire, too. It really highlights that special partnership they have.
They're not just business partners, they're true friends, and it shows in how they run the company.
And the program itself is incredibly simple, very low administrative costs, which Buffett, of course, loves.
He even joked that their total corporate administrative costs are only about half of what they donate to charity through this program.
Talk about efficiency.
He also shares some interesting figures about the types of organizations that benefit. Universities, arts organizations, social service agencies, all sorts of worthy causes.
It's really inspiring to see how Berkshire's shareholders are using their wealth to make a difference. And then there's that funny story about the corporate jet.
Oh yeah, the one where they eventually sold it because it was getting too expensive?
Classic Buffett poking fun at himself.
And then there's Munger, of course, who'd rather take a discounted bus ride any day.
Those two, they're a great pair. Speaking of managers, Buffett also touches on a problem that's all too common in corporate America, underperforming CEOs who just won't go away.
They become entrenched, and it can be incredibly hard to get rid of them, even when it's clear they're not the right person for the job.
It's a real challenge for boards and shareholders, and it underscores the importance of long-term focus, which is something that Berkshire has always been known for.
They've got this incredible shareholder base, people who are in it for the long haul.
Buffett believes they have the longest investment horizon of any public company. Many of them plan to hold their shares until they die, passing them on to their kids.
That's a pretty unique situation, and it allows Berkshire to think differently, to make decisions that might not pay off immediately but will create value over decades.
Exactly. Now, let's talk about executive compensation. This is an area where Buffett and Munger have some pretty strong views, especially when it comes to stock options.
Right, they're not big fans of those, are they?
They believe that stock options can lead to all sorts of perverse incentives. You can end up with managers getting rewarded simply for the passage of time, for retaining earnings, whether they're reinvested effectively or not, or even for just riding the wave of a booming industry.
So they might get rich, even if they're not really adding much value.
Precisely. Buffett also points out that you rarely see long-term fixed-price options being granted to people outside the company, and he believes that the initial price of any option should truly reflect the business's value at that moment. He contrasts this with the insanely complex compensation packages that you often see cooked up by consultants.
Right, those multi-page monstrosities that are impossible for anyone to understand.
He much prefers simple, straightforward agreements, like the one they had with Ralph Shea at Scott Fetzer. 5 minutes and they were done.
That's efficiency for you.
And it underscores the importance of fairness and aligning interests. Now, he makes the point that only he and Munger, as those responsible for the entire enterprise, should really have their pay tied to the overall company performance. But, their real reward comes from the joy of their work.
They genuinely love what they do, and they hate tedious tasks, which is something I think a lot of people can relate to.
He also talks about the unique compensation system at H.H. Brown, one of their subsidiaries.
I'm curious, how does that work?
So the managers there get a low fixed salary, plus a big chunk of the after-tax profits.
Sounds like a pretty good deal.
But here's the catch. They deduct a charge for the cost of capital from those profits before calculating the manager's share.
Ah, so it's not just about generating profits. It's about generating returns that exceed their cost of capital. They have to create real value.
Exactly. It really forces them to think like owners, to allocate capital wisely. Now, let's talk about common stocks and the alternatives. This is where Buffett introduces that wonderful concept of Mr. Market.
Ah, yes, Mr. Market, the embodiment of market sentiment. It's one of those concepts that every investor needs to understand.
It's a brilliant analogy, isn't it?
Absolutely. So, for those who haven't heard this before, can you explain who Mr. Market is and why he's so important?
Okay, so imagine you have this business partner, Mr. Market, and every day he shows up at your door eager to buy or sell you shares of your business.
And the kicker is that Mr. Market is incredibly moody.
Oh yeah, he's all over the place. Some days he's euphoric, wildly optimistic, offering you sky-high prices. Other days he's depressed, gloomy, practically begging you to sell at a low price.
So, what's the key takeaway here?
The key is that you don't have to play his game. You can completely ignore him if you don't like his offers.
You don't have to buy or sell just because he's in a particular mood.
Exactly. Mr. Market's emotions are your opportunity. Buy when he's fearful, sell when he's greedy.
And never forget, he's there to serve you, not to dictate your investment decisions. Now, another point Buffett stresses is the advantage Berkshire gets when companies they own buy back their own shares.
Especially when those shares are undervalued, it's like getting free ownership. Their stake in those companies just keeps growing without them having to put up more money. And it all comes back to that focus on the long term. Buffett constantly emphasizes that the underlying business performance is what truly matters. He often says that if they owned the whole company outright, they wouldn't get a daily stock quote. So why obsess over those short-term fluctuations?
Right, it's about the business, not the ticker symbol. Now, let's move into a realm of arbitrage. This is an area where a lot of people might think, wait, isn't that super risky? But Buffett's approach is actually quite conservative.
Oh yeah, it's not about those high-flying, risky bets that you often hear about.
So how does he define arbitrage?
For Buffett, arbitrage is all about profiting from publicly announced corporate events, like mergers, acquisitions, that kind of thing.
So it's more about analyzing the likelihood of a deal going through and making a calculated bet on that.
Exactly. They steer clear of rumors, speculation, all that noise. They just stick to the facts, and they have this rigorous process for evaluating each opportunity.
What kind of questions do they ask themselves?
Well, first they want to know, what's the probability that this event is actually going to happen? Is this deal likely to close or is it going to fall apart? Then, how long will their capital be tied up? They don't want to be stuck in a deal for years if it drags on. And is there a chance something better might come along in the meantime? Another opportunity that offers a higher return. And finally, what are the potential downsides? What could go wrong and how much could they lose if the deal goes south?
It's a very disciplined, analytical approach.
He even shares that story about the Acacia acquisition that got delayed, to show that even when you have a signed agreement, things can still go wrong.
It's a reminder that nothing is certain in this game. He also mentions their big arbitrage play on RJ on Nabisco, which turned out pretty well for them, but he warns against what he calls the greater fool theory.
Yeah, that's the idea that you can buy something overpriced and still make money because there'll always be a greater fool who's willing to pay even more.
That's a recipe for disaster.
It's speculation, not investing. Now, one of my favorite sections in the book is where Buffett tackles what he calls the prevailing wisdom. He really takes aim at some of the most widely held beliefs in the financial world.
He's always been a bit of a contrarian, hasn't he? So what are some of the ideas he challenges here?
Well, for one, the efficient market theory.
Right, the idea that stock prices always reflect all available information, that it's impossible to consistently beat the market.
Buffett acknowledges that markets can be efficient a lot of the time, but he doesn't buy into the notion that they're always perfect. He points to his own track record, the success of Graham Newman, the Buffett partnership, all that.
Decades of outperformance, it's hard to argue with that.
And he loves the idea of having opponents who are convinced that thinking is a waste of time. He says it's a huge advantage in any competitive field. He also challenges this idea of selling your winners and holding on to your losers, what he calls cutting the flowers and watering the weeds.
Yeah, that's a behavior that's all too common among investors, isn't it?
We get attached to our losing stocks, hoping they'll come back, and then we get scared and sell our winners too early, missing out on the really big gains.
It's an emotional trap.
Exactly. Buffett says it makes no sense to sell a piece of a wonderful business that you understand and believe in just because the price has gone up. He even uses this great analogy. Imagine a parent company selling off its crown jewel subsidiary just because it's doing well.
No rational parent company would do that.
Right, it'd be crazy. And he gives this example from an article about Coca-Cola where people kept saying it was too late to buy the stock year after year.
And of course they were wrong. The stock kept going up.
The point is, if you have a truly great business, don't be so quick to sell it just because it's gotten more expensive. Now, this ties into their concentrated investment strategy, which is another idea that goes against conventional wisdom.
Most financial advisors tell you to diversify widely, to spread your bets. But Buffett puts all his eggs in a few baskets, doesn't he?
He argues that when you really understand a business, when you've done your homework, concentrated investing can actually be less risky than broad diversification.
Less risky. How does that work?
Well, his definition of risk isn't the same as how Wall Street typically defines it. For him, risk isn't about volatility. It's about the potential for permanent loss of capital. And when you really know a business inside and out, you can minimize that risk.
So it's all about understanding the businesses you own, not just owning a little bit of everything.
He points out that the beta of companies like Coca-Cola and Gillette, which have these incredible competitive advantages, is often no different from some mediocre business that's much more vulnerable.
Beta, that's the measure of volatility, right?
Exactly. And he's saying that using beta to measure risk, well, it can be misleading. It doesn't tell the whole story. And they also deliberately avoid those fast-changing industries, the ones where it's really hard to predict the future. They stick to businesses that are easy to understand, where the economics are clear, and where they can see the path to future growth.
He says it's like looking for a needle in a haystack. You don't need to search too hard, and the needle's right there in plain sight.
Now, he does acknowledge that broad diversification can make sense for people who don't have the time or the expertise to analyze individual businesses.
Right. If you're not going to do the work, if you don't feel confident in your ability to pick stocks, then a broad market index fund can be a good option.
Exactly. But for Berkshire, their approach is all about that long-term committed ownership. They want to find those wonderful businesses and stick with them.
Okay, let's move on to this section called value investing at tautology. Sounds a little academic, but I'm sure there's a good lesson in there.
It is. It's actually a pretty simple idea. Buffett is basically saying that value investing isn't some special esoteric thing. It's just intelligent investing, plain and simple.
So it's about paying attention to value.
Exactly. He references this formula by John Burr Williams, which basically says that the value of any asset is the present value of all the future cash flows you expect to receive from it. And he's saying that applies to everything, whether it's a stock, a bond, a piece of real estate, whatever.
So if you're not thinking about the relationship between price and value, you're not really investing, you're speculating.
Right. And then there's Graham's concept of the margin of safety, which is super important.
The margin of safety, that's the buffer you build in to protect yourself from being wrong.
Exactly. You buy something for a significant significantly less than you think it's worth. So even if you're a little off in your estimates, you're still likely to come out ahead. And Buffett also points out that you're more likely to find those bargains in the secondary market, buying existing stocks and bonds, than in new issues.
So IPOs, those aren't usually the best place to find undervalued assets?
Nope, they're often priced to perfection, and then some. Now, in the section on intelligent investing, Buffett starts by making a point that might surprise some people. Sometimes doing nothing is the smartest move.
In a world that's obsessed with action, with constant buying and selling, that's a pretty radical idea.
But it's true. Buffett questions why investors are so quick to sell their winners and hold on to their losers, why they jump at every little piece of news or market fluctuation. He believes that a truly intelligent investor thinks long-term and focuses on the underlying business, not the short-term noise.
It's about tuning out the distractions and staying focused on the fundamentals.
And he emphasizes that investing in public companies is really no different from acquiring entire businesses. You're looking for those same qualities: great economics, strong management, and a fair price.
The scale might be different, but the principles are the same. He also talks about how they view technological change, right?
Yeah, he acknowledges that change is constant and that it's creating all sorts of new opportunities. But he also says that as investors, they prefer to avoid those industries that are going through massive transformations. He compares it to space exploration. It's exciting, but they'd rather watch from the ground than be on the rocket.
I love that analogy.
It's so Buffett, isn't it? So they stick to those inevitables, the companies that have products or services that are going to be in demand for decades to come, regardless on what's happening in the tech world.
So companies like Coca-Cola, Gillette, those kinds of businesses.
Exactly. But he warned that even with those inevitable, it's still possible to overpay. And he felt that at the time he was writing this, the market was pretty overheated, that there weren't a lot of great bargains to be had.
He's all about buying those wonderful businesses at reasonable prices. But sometimes you just have to be patient and wait for the right opportunity.
Right. And his advice for those times is, if you aren't willing to own a stock for 10 years, don't even think about earning it for 10 minutes.
That's a great quote.
It really highlights that long-term mindset. Now, he also talks about this idea of the fat pitch, which is another baseball analogy. He compares investing to being a batter. And you don't have to swim at every pitch. You can wait for the one that's right in your sweet spot.
So it's about being selective, not chasing every opportunity that comes along.
Right. Sometimes the best move is to just stand there and watch the pitches go by. And he also touches on that cigar butt approach that he used early in his career, buying those really troubled companies for pennies on the dollar.
But he doesn't really recommend that approach anymore, does he?
Not really. He realized that while you can sometimes make a quick buck with those cigar butts, they often come with a lot of problems, and the returns are usually pretty meager. It's not a sustainable way to build wealth. Okay, let's shift gears again and talk about speculative bonds, those so-called junk bonds. This is an area where Buffett has always been pretty cautious.
Yeah, he doesn't like taking unnecessary risks, and junk bonds, well, they're definitely risky. What are some of his concerns about this sector?
Well, he's particularly wary of the banking industry because of the high leverage they use. They're borrowing a lot of money to make loans, which means even a small mistake can have a big impact. And he's seen a lot of those mistakes over the years, a lot of bad management decisions. He does, however, make an exception for Wells Fargo. He was impressed with their management, their culture, their track record.
So it's not that he's against banks entirely. It's about finding the right forms, those with strong management and a prudent approach to risk. But when it comes to junk bonds, he's generally skeptical, even when they're trading at deep discounts.
He says they're a minefield, and he's right. But he did make an exception for the RGR Nabisco bonds.
What was the thinking behind that?
He believed that the market was overreacting, that RGR's creditworthiness wasn't as bad as everyone thought, and the high interest rate they were offering, plus the potential for capital gains if the company turned things around, that made it worth the risk.
So it was a calculated bet based on their analysis of the situation.
Exactly. He contrasts this with Michael Milken's argument for diversification in junk bonds. Milken believed that if you spread your bets across enough junk bonds, the risk would average out.
But Buffett's not buying into that.
Nope, he believes in concentrating his bets on those opportunities where he has a high degree of conviction, where he understands the situation better than the market does.
Okay, let's move into zero-coupon bonds. What's the deal with these?
Well, the main advantage of zero-coupon bonds is that they eliminate reinvestment risk. When you buy a regular bond, you get those periodic interest payments, and then you have to figure out what to do with that money, how to reinvest it.
Right, you have to find another investment that offers a decent return.
With a zero-coupon bond, you don't get those payments. All the return comes at maturity.
So you know exactly what you're going to get and when you're going to get it.
Exactly, and this makes them particularly attractive for investors who have long-term liabilities like pension funds. They need to know how much money they'll have at a specific point in the future, and zero-coupon bonds provide that certainty. But Buffett also cautions against focusing too much on metrics like EBITDA, which is earnings before depreciation, interest, and taxes.
What's wrong with EBITDA?
Well, it ignores the fact that most businesses have to spend money on capital expenditures, to maintain their operations and stay competitive. He uses the analogy of financing a car. You have to account for the depreciation of the car, not just the interest payments.
So EBITDA can paint a misleadingly rosy picture of a company's financial health.
Exactly. Now, let's talk about preferred stocks. Buffett emphasizes the importance of partnering with people they like and trust.
He's all about those strong relationships, isn't he?
Oh, yeah, he names people like John Gutfreund, Coleman Mockler Jr., Ed Kolodny, Andy Sigler, all these CEOs who he really respected. He believes that having those strong personal connections, that trust and mutual admiration, it makes a big difference in the long run.
It's about more than just the numbers, it's about the people.
And while he acknowledges that preferred stocks aren't likely to deliver the same kind of returns as finding those undiscovered gems or buying a controlling stake in a fantastic company, he also knows that those kinds of opportunities are rare, especially at the scale at which Berkshire operates. He then talks about their investment in USA, which, let's be honest, didn't turn out so well.
Yeah, that was a tough one.
He acknowledges the challenges facing the airline industry, the high costs, the intense competition, all that. And he admits that they had to write down a big chunk of their investment.
He even admits that they made a mistake in how they structured the deal. He wishes they'd bought common stock instead of preferred stock.
And he puts a number on that mistake. Hundreds of millions of dollars in potential gains that they missed out on.
It's refreshing to see that kind of honesty and self-awareness. He also contrasts USA Air with their investment in Gillette, which was a huge winner for them.
One of their best investments ever. But again, he wishes they'd bought the common stock instead of the preferred.
He seems to have learned from that mistake.
Okay, let's talk about Berkshire's stock. Why doesn't it trade as much as other big company stocks?
Good question. I imagine it has something to do with the high price per share.
That's part of it, but it's also the type of shareholder they attract.
People who are in it for the long haul.
Exactly. They're not interested in day trading or making a quick buck. They're long-term investors who believe in Berkshire's approach.
Which aligns perfectly with Buffett and Munger's philosophy. They're building a company for the long term, and they want shareholders who share that vision.
Now, he also talks about their decision to list on the New York Stock Exchange.
I always wondered about that. It seems a little counterintuitive for a company that discourages frequent.
That's it for today. Until next time, happy investing.